Hello everyone, this is the part 2 of chapter 3 ACCA F3 Financial Accounting, and the chapter's name is Double Entry Bookkeeping. So before watching this video, make sure that you watch the basic journal entry video as well as the part 1 video. So when you have watched that, then you can come back to this. The playlist of everything and the links are given in the description box below. So we have to start with, let's start with where we left it from. Right. So let's start with the petty cash book. Right. So what do you understand by petty cash? So now you know what a petty cash book really means. So the cash which is kept by the business for small expenses, petty expenses which go on in the business, which is not related to their actual operation of a business, that is known as a petty cash. So now these are the controls which need to be taken care of when you have petty cash. You can pause the video and go through it. So this is what is known as a petty cash book. Now I'll tell you what petty cash book really means. So the businesses keep some little bit amount aside for the control of petty cash. So what really happens is that whenever by the end of the month or end of the week or whatever period they choose to have in progress, so whatever the period is, let's say I have petty cash of, let's say, rupees 200, right? So if I have rupees 200 as my petty cash, and in my petty cash I have used 100 rupees, so I've used up my 100 rupees, right? So by the end of the period, I need to recharge my petty cash account. So how much money will I recharge my petty cash amount with? So since I've used up 100 accounts, we will again be putting 100 rupees so that the balance again becomes 200, right? Because you need to top up the initial balance by the end of the period. So that's how the petty cash book system works. So what is a petty cash float? So the amount of money which we are withdrawing from the bank, that is known as a petty cash float. So this float will be used to pay off the various sundry expenses. So as we have withdrawn rupees 100 as petty cash, right? So that is known as the petty cash float. So what do you understand by float? Float is nothing but the money which we withdraw from the bank, which we use for the expenses. And by the end of the period, we recover the petty cash and we again recharge it or top up the balance. Now let's come to what a journal is. So you know what journal is. The transactions which do not go in any other books, they go to the journal. So in this chapter, you will probably not be able to understand most of the books, but that is okay because we will be studying them in detail in the further videos. So first, now let's see the examples. So there are various types of transactions which are written down and noted in the journal. So the first one is the year-end adjustments. So there are various types of adjustments which are done during the year end. So they don't go into any other books, but they go into the journal. So now when you talk about acquisitions and disposals of non-current assets. So what are non-current assets and what are current assets? We have done that. Non-current assets are the long-term assets which cannot be converted into cash within a year, right? So correction of errors, opening balances for statement of financial position items. So there are various things which are recorded into the journal. The journal is a clear and comprehensible way of setting out a bookkeeping. So now when you talk about presentation of a journal, so a journal should be laid out in the following way. So this is how a journal should be, and this I have explained it earlier, and even if I haven't, I will link that in this video once again. Why? Because I want you to watch it over and over again and get familiar with it. So I'm gonna link it right here. Yeah. Now we will be learning something which is so essential in order for you to understand the previous concepts as well as the concepts that are there in the next chapters and everything. You need to understand and keep in mind these basic rules, and they are, okay, first thing we have is an asset. So let's write that. So the first thing we have is an asset. What you need to keep in mind is whenever assets increase, the balance is always debit. Whenever your asset increases, what's the balance? That is debit balance. And I want you to write it down in your notebook so you don't forget it. And now when we talk about a liability, it's just the opposite. So for a liability, whenever a liability increases, it says credit. Just keep in mind. Now when you think about what else, expenses and assets always come together. Even the expenses get debited. And when it comes to liability, whenever there are even incomes are having credit balance. Now let's discuss them one by one. Just keep in your mind that assets and expenses always come together, liabilities and incomes always come together. So whenever your asset increases, it gets debited. Whenever your expenses increase, they get debited. Whenever liability increases, it gets credited, and whenever your income increase, that also gets credited. All the expenses and losses are debited, all the incomes and gains are credited, right? So just recall whatever we have again. So you know where incomes, gains, various other various liabilities, incomes, gains and liabilities, they all have a credit balance. And what about the rest which we have seen? So whenever you have losses or expenses and assets, they get nothing but debited. So now when it comes to the journal entries, let's see how it goes. Let's have a question wherein we have made a purchase. So what happens when I purchase something? Think about it logically. As I purchase something, I give out cash for it, right? Which means my cash is decreasing. Why? Because I'm purchasing something. So what should happen to the cash? What is the cash? First tell me. Cash is asset, right? And what did we discuss earlier? We discussed that whenever your asset increases, it gets debited. Here in the question, our asset is getting decreased because when we purchase something, we pay cash for it. So our cash balance is getting decreased, which means our asset is getting decreased. Which means in this case, the opposite will happen. So since it has a debit balance, now it gets credited. So in this situation, what do? So when there is purchase, you credit the cash account, which means you debit the purchases account. Simple. Now let's talk about sales. What happens when you make a sales, right? So what happens when you make sales? When you make sales, cash is received. What is cash? Cash is an asset. What did we talk about? Asset. When asset increases, it gets debited. What did we talk about that? So cash is getting increased since we're making sales. So what is happening to cash? Cash is increasing, which means assets are increasing. This obviously means that we need to debit cash and we need to credit sales, right? Easy. So it's really simple. If you need to keep in mind these few things, whatever we have discussed earlier. So if you have them in your mind, the entire chapter is going to be very easy for you guys, so don't worry about that. Okay, so now those are the basic rules which we have discussed. So now let's just discuss the same rules in a systematic manner. So whenever assets, expenses, losses increase, then they get debited. Whenever assets, expenses and losses decrease, then they get credited. Easy. Now, whenever liabilities, incomes, and gains increase, so whenever they increase, they get credited, and whenever they decrease, they get debited. So these are the few rules you need to keep in mind. So if you are clear with them, then you will not face any problems in any of the journal entries. Okay, so in this question again, Igor Romanov runs a Russian restaurant. He is a very good chef, but not quite so good at accounting and needs help to record the following transactions. So these are the so these we need to put up some of the journal entries in this question. So even if you're confused right now, that is okay, because by the end of this few chapters you will be thorough with it. But let's just discuss it orally. Please ignore the mess I have made, even though most of the answers are written. So the closing inventory of vodka at a cost of this has not been recorded. So closing inventory hasn't been recorded. So now you are recording it. So obviously assets are increasing. So assets get debited. Igor needs to charge depreciation. Depreciation is an expense. So the expenses get debited. A regular customer, so there is a person V Shady who has not paid the money. So when someone doesn't pay the money, they are known as bad debts. So that is an expense to the business. Again, expenses are debited. On the last day, 2 new sofas. Sofas are assets. Furniture gets debited to cash. Right. So now we have the ledger accounts and the division of the ledger. In most entities, each class of transaction and their associated assets and liabilities are given their own account. So after the journal, we make some accounts, and those accounts are known as ledgers. Right. So for example, there will be separate accounts for sales, purchases, rent, insurance, costs, cash assets, inventory assets, liabilities. And so there are accounts for every person, entity, or whatever, supplier, customer. So these are known as ledgers. You will be learning them also in the further chapters. So these account in the system, these accounts are known as ledgers. So let's talk about what ledger really means in a more simple format. In simple terms, the ledger accounts are where the double entry records of all transactions and events are made. So there are the principal books of files for recording and totaling monetary transactions. So what do you understand by monetary transactions? Whatever transactions take place in which money is involved, they are known as monetary transactions. So an entity's financial statements are generated from summary totals in the ledgers. So the term general ledger is used to refer to the overall system of ledger, right, and accounts within a business. It houses all the separate ledgers required to produce a complete trial balance. So trial balance is something which also comes forward, okay? So that is also something which comes after making the ledger. So we will come to that also in detail. And here I have just written the balances once again, because I want you guys to remember these balances, which items have a credit balance and which has a debit balance. Right. So now we are going to end this chapter, but we'll just read what is left. See, this is the most basic stuff in the chapter, and I'm sure that you know almost everything because you have studied this earlier. But when you do the other chapters, we'll be studying each one of them in a very detailed manner. So after doing those chapters, when you come back to this chapter again, this chapter will become easier for you. So don't worry if you're not able to understand right now, that's completely okay. So books of prime entry are covered in more detail in the later chapter. So this is exactly what I just said. Okay, so now let's see how the accounting equation works. So first, what happens first? In the beginning, the transaction firstly occurs. So whatever transaction happens, it takes place. After that happens, it is recorded in the ledger accounts. So we had discussed what ledger is. So every entity has an account of its own. So whatever transactions are taking place, they get reflected in the ledger accounts. Moving on from the ledger accounts, we balance the ledger accounts. So as in when we balance the ledger accounts, you get certain balances. We will look into that as well. And those balances, we write them in the trial balance. So what happens after the trial balance? So the year end adjustments, so we have discussed that, right? Whatever adjustments are required and everything, we do that. And then the last but not the least is the financial statements. So you know what financial statements are, right? The end thing. The reason why we are doing all this is because of that, right? So that's that. Now, each transaction that a business enters into affects the financial statements in two ways. So, what are the ways in which every transaction affects? A business buys a vehicle for cash. Okay, before we read further, let's just read the statement and try to know which account is debited and which account is credited. We have done it, so I'm assuming that you know it. Business buys a vehicle for cash. So, cash is our asset. What is happening to cash here? When you are buying a vehicle, cash goes out. So, minus. What do you understand by minus? Our asset is reducing. Asset is reducing. What did we study about this? That when assets are increasing, we need to debit them. So, when assets are decreasing, we will credit them. Very good. And I'm sure you all got this. So, cash will get credited. Good. So what do you understand? So if cash is getting credited, the other account will obviously get debited, right? But still, when you go about our approach, let's see how that works. So we have what a vehicle is, right? We have what a vehicle is. Vehicle is an asset. So since we are buying it, our assets increase. When our assets increase, what happens? It gets debited. So obviously we will debit the vehicle account or asset account. Okay, so now let's read what it says. It has increased the vehicle assets. It has at its disposal for generating income. There is a decrease in cash available to the business. That's literally what we just learned about, right? To follow the rules of double entry, each time a transaction is recorded, both effects must be taken into account. These two effects are equal and opposite, and that accounting equation will always be maintained. So that's what we've been learning so far, that every transaction that takes place has double entry, two effects. One is the debit effect and one is the credit effect. So either way, both of them are taking place. So it always gets, when you debit an account, another account is automatically credited. That's what we've been seeing so far, right? When you have a purchase, when you buy a machinery, cash accounts gets credited but the machinery account gets debited. So for every transaction in accountancy, there is an equal and opposite account, like transaction. So now let's see what the accounting equation is. So the accounting equation is what forms the basis of accountancy. If you understand how an accounting equation works, you will be understanding how a journal entry works. And if you understand how a journal entry works, you will understand ledger, then trial balance, and the final financial statements, and so on. So it is very important to have the concept of accounting equation clear, because it forms the basis of everything. So what does accounting equation say? Accounting equation says that assets equal to the equity plus liabilities. So when you talk about equity is nothing but capital. So don't get confused whenever you see the word equity, because equity is nothing but the same as capital. So assets are equal to capital plus liability. Assets are equal to the equity plus the liability. So what are the assets of a business? Assets of the business are their liabilities plus their capital or equity. So obviously, what is this? The second equation is just the minor. They have taken liabilities to the left hand side, which means minus. So and they have taken so when I just a second, right? So when I talk about assets is equal to the capital plus liability, if I take it to the other side, assets minus capital is equal to liability, assets minus liability is equal to capital, and so on. So I can derive it however I want to, but you understood what I mean. So the only formula you need to keep in mind always is that assets is equal to equity plus liability. The statement of financial position. So you know what the statement of financial position is? The statement of financial position is the balance sheet. Shows the position of a business at one point in time. A statement of financial position will always satisfy the accounting equation as shown above. The accounting equation is a simple expression of the fact that at any point in time, the assets of a business will be equal to its liabilities plus the equity of the business. Right? Got it? So now let's see the illustration. So you know how it is. I am sure you know, and when you start solving these questions, it will get clearer in your head. The transactions of a new business in its first 5 days are as follows. Avon commenced business introducing 1000 cash. Okay, now tell me, without looking at the solution, what should it be? So the first thing we need to do is identify. Okay, I'll tell you. So I'm taking some steps for this. How do you solve a accounting equation question? An accounting equation question. So the first thing you need to do is identify both the accounts in the question. Identifying both the accounts in the question. When you identify both the accounts, it gets easier. After identifying them, use the approach which I have taught you. Which one is debited and which one is credited. So you know what the approach is. When assets, expenses increase, they get debited, and when liabilities, incomes and gains increase, they get credited. And the opposite, you know what the opposite is. When assets decrease, they get credited. So I know I keep repeating this over and over again, but this is only so that you understand this and have this by heart in your minds. Okay, so what was our first step? Our first step is to identify both the accounts. So Avon commenced business introducing 1000 cash. So the first thing we know is that cash is our first thing, right? And introducing, commenced a business, which means capital is involved, right? Capital is also involved and cash is involved. So what do you understand in the first question? Cash is increasing, so is capital, right? Since cash is increasing, we need to debit the cash account and we need to credit the capital account. So the capital which gets introduced in a business is a form of liability. I know you will not be able to understand this, but just keep it in your mind that the capital which is introduced in a business. So one thing which you have to remember for the entire chapter is that the capital which we use, the equity which we use, is a form of liability. That's why whenever we make a balance sheet, under the liabilities column, the equity or the capital comes inside the liabilities column. If you can recall, or if you are familiar with the balance sheet format, what does it say? The balance sheet format says that this is how it looks. You have assets this side, right? And you have liabilities this side, right? So this is how it looks. So, and the capital always comes inside the liabilities, right? I hope you remember this format. So whenever you think about capital, you need to keep this picture in your mind, that capital always comes inside the liabilities in the balance sheet, which means the equity or the capital is also a form of the liabilities. Now let's come back to our question, right? So yeah, so the first one is Avon commenced business introducing $1000 cash. So now tell me how it is like. So if Avon is starting the business with a cash, what should that mean? 1000, right? So now let's just write the answers over here. and I want you to try to do it yourself. So this is a formula which we have seen, which is nothing but assets is equal to capital plus liability, or equity plus liability. Equity is nothing but capital, right? Now read the question again. Avon commenced business introducing 1000 cash. So cash is an asset, which means 1000 comes in the asset column, right? 1000 is the cash, and we also said that he is getting it in the capital, so capital also increases, right? And equity, even the so yeah, wait, first listen to me. So asset, and we know that the capital is getting increased, the equity is getting increased, right? And nothing in the liabilities for now, right? So this is the accounting equation. Now if you want to write the same thing, this was easy to make an accounting equation. If you want to write the same transaction in the format of a journal entry, then you have to write cash account debit to capital account. Why is capital account getting credited? Because you follow the same rule which you use for the liabilities. So whenever a liability increases, what do? You credit it. That's why you are crediting the capital. But I hope you understood how to do the accounting equation. This is the part A, right? Now let's do part B. Sorry, let's do day 2. This is day 1, right? Okay. Now let's do the day 2. What is day 2? The day 2 is bought a motor car for $400 cash. So you bought a motor car, $400 cash. So motor car is the first account and cash is the second account. The first step was what? Finding out what accounts are involved. So the motor car, which is an asset, and the $400 cash. So cash and assets are the accounts which we need to take into the consideration, right? So you bought a motor car. So you bought a motor car for $400, right? So the first thing we have is asset. So the asset increases from $400, let's say. And cash, what is cash? Cash is an asset, so $400 also gets subtracted. Now what happens then? It's gonna remain the same, right? This is a cash and this is the motor car. So hence there is no change in the accounting equation, right? Okay, moving on. Let's see what the day 3 is. Obtained 1000 loan. So what are the two accounts? The first thing is loan and the second thing is cash or bank. Why? Because the loan comes in the format of a cash or bank, right? So what comes here? Let's check. So just see this. Asset, liabilities. So the loan we need to pay and the cash has come in. So we put 1000 here and 1000 in the liabilities. Liabilities is nothing but the loan, right? Now let's see what day 4 is. Day 4 is purchase goods for 300 cash. What are the two accounts now? Purchases and cash. So purchases are increasing and the cash is decreasing because you need to pay the cash in order to give the you need to pay the cash in order to get the assets, right? So don't get confused by seeing here they have just added from day 1 to day 5 everything and shown. We are doing each of them separately because I want you to understand it better. So what happens when you buy purchases for 300 cash? Assets is equal to capital plus liabilities. So goods cash is reducing minus how much was the cash? How much was the cash? $300. So you minus $300 and purchases are coming in, so it becomes plus. This is the purchases. Purchases is nothing but stock. Stock is nothing but it comes into the assets, right? So that is the treatment of the day 4. Now let's see what day 5 is. So sold all of the goods purchased on day 4 for 400 on credit. So now let's see what all are involved in this. So whatever goods they purchased, they sold, which means sales is taking place for this much rupees on credit. So what does credit mean? Credit means that you have not received the money yet, right? And it was of $300, right? In the day 4 you can see it was of $300, but we sold it for 400. What does that mean? $100 is our profit. And what happens to profits? Profits always get added into the capital or equity of the business. So now let's see how we do that. Okay, so this is the carried forward balances of the previous days. So don't get confused with that. We are making a separate accounting equation for every day, but in the end you need to just keep going and writing the final answer. I will explain that in the end. So first let's see how do you do this. Assets is equal to capital plus liabilities, and you sold something. So you sold what? Sold all the goods purchased on day 4. $300 worth goods were there, right? Why am I not writing 400? Because 400 is the cost, but we had only 300 worth goods, so you're minusing 300. And it is a what? You see, credit sale. So what is a credit sale? Credit sale is something which means that you will be receiving the money in a later date, right? On a later date. So which means it is a receivables. And what are receivables? Receivables are asset. So you have a receivable of what? 400. You need to receive $400 from somebody, which is an asset. Now $100 is our profit. So profit gets added to the capital or equity. So now I think it's clear for you all how you make the equations. Clear? So the equation gets balanced. Now let me tell you what they have done in the solution. So what they've done is they wrote, this is what you need to do too, and I'm sure that this is very basic, but they have written assets is equal to equity plus liabilities, right? So after this is the day 1. They did the day 1's transactions, then they wrote day 2, they did the transaction, then they did day 3, then they did day 4 and day 5, and at the end whatever balances are left they showed that. This is what you are supposed to do. The way we discussed everything on a like individual basis, you just have to do it together. So I hope it's clear. Okay, so we are done with the illustration 3. Now let's move on to the ledger accounts, debit and credits. So now we come to the ledger accounts. Just a second. Yeah. So what are ledger accounts? So you know that after making a journal, you make the ledger account. Ledger account is nothing but this is just a form of journal only. I mean, whatever you write in the journal, that is put up in the ledger, right? So now let's see how that works. Transactions and events are eventually recorded in the relevant ledger accounts using a double entry to reflect the duality concept explained previously. There is a ledger account for each asset, liability, equity, income and expense item. Traditionally, each account is drawn as an enlarged T that has two sides, a debit and a credit note. So the ledgers are also called as a T-shaped account. I hope that's clear. So ledger is also called as a T-shaped account. T-shaped account. Right. So whatever item we have, asset, liability, equity, whatever it is, every single item has a ledger account of its own. Traditionally, each account has drawn as a T. Yeah. So we just saw that it is in a T shape. Now let's see the format of how a ledger account looks. So date, narrative amount, name of the account, and the left side for me, the left side is always a debit and the other side is always the credit. And I don't think there's any confusion in this. This is literally how you made ledger accounts even in your 11th grade. So how was a ledger account? Let's say this is a car account. Car is an asset, car account, and this side is always my debit, this side is always my credit, and we have date, particulars, amount, date, particulars, amount. So this is what a basic format of a ledger really looks like, right? So now I'll give you an example. If my question says that you bought a new car for 100 rupees, let's say. Okay, you bought a new car for 100 rupees. What will be the journal entry of this? Tell me. Cash goes out, which means cash is getting credited. An asset goes out, which means it's getting credited. And a asset comes in, the car comes in, so it gets debited. I hope you're familiar with the rules now. I'm not going to explain it. So car account debit to and cash account gets credited, right? This is the journal entry. Now whatever we wrote here, you just need to put it down in the account. So what is happening to the car account? Car account is getting debited. It is getting debited to what? It's getting debited to cash. So car account is getting debited, so we see the debit side and then we put the cash here. Now if you want to see it as another example, let's say we are selling the car. We are selling car for cash. So what happens? Cash is coming in, cash account debit, and car is going out, car account credit. So what is happening to car here? Car is getting credited, right? So which means car is getting credited, so we put cash over here. I hope you understood how we make a ledger account and how the journal entries are posted into the ledger accounts. So this is very simple and very basic. Okay, so now the duality concept, that each transaction will have affect at least two ledger accounts. So that's what we saw. Whenever we were selling a car, the cash was also getting affected. Whenever we were buying a car, the cash was also getting affected. So every transaction has a double entry or the dual effect. So that is something which every transaction makes a change in two ledger accounts. So one account will be debited and the other will be credited. Whether an entry is to the debit or credit side of an account depends on the type of the account and the transaction. So now let's see the table. So we have a debit side which has increases in purchases, expenses and assets, and credit side we have an increase in revenues, liabilities and shareholders equity, right? So this is something which I have already taught, right? I have explained this rule for you before doing this, so now you'll understand it better. And increase in liabilities and increase in shareholders equity, both credit. So I told you that shareholders equity is a form of a liability only. So the same rule which takes place in the liability takes place even in the shareholders equity. You can use the mnemonic pearls to help you remember this vitality important double entry rule. Yeah, so this is another abbreviation or a mnemonic, but it's up to you. It is important to note that the opposite is also true. So you know what the opposite is. If asset is getting increased, if it's getting debited, if the asset is getting decreased, it will get credited. So the opposites are always also true. We have seen that also. So now let's see summary of the steps to record a transaction. Identify the ledger accounts. Consider whether the account balances are being increased or decreased. Decide whether each account should be debited or credited. Check the debit entry and the credit entry have been made and they are both for the same amount. Right, so that's it. We are done with this chapter, and this chapter was the basis of your entire studies. So I hope you understood this chapter. If you have any doubts, you can watch the video again and I've linked all the videos in the description box below, and if you have any doubts you can comment the same or drop me a mail. I've given the mail ID also in the description box below. So that's it. Let's just quickly see the chapter summary. So transactions occur. If it is a cash transaction, we put it in the cash book. If it is a credit sales, in the sales day book. Credit purchases, purchase day book. So where you also have a sales return book, purchase return book, petty cash book and the journal. So there is a dual record for every transaction, and the dual records are dual effects are recorded in the ledger accounts. So for every debit entry there is also a credit entry. So this is the pearls, and this is something which we have revised, but let's revise it again. Whenever an asset increases, it gets debited. whenever an expense increases, even that gets debited. And whenever assets decrease, they get credited, and whenever expense also decreases, it gets credited. And now when we come to a liability, whenever a liability increases, it gets credited. Whenever a liability decreases, it gets it gets debited. And whenever an income increases, it gets credited, and whenever an income decreases, it gets debited. And I hope this is clear for you now, because I've revised this multiple times. And you also know that shareholders equity or shareholders capital is a form of liability, so the rule which is taking care of the liability is the same rule which take care of the shareholders equity. Now we have the test your understanding answers here, but I have already discussed the test your understanding, so I don't think you will have to do it right now. But however, there's one thing you need to keep in mind is that whenever you just a second yeah whenever you make a cash book or a purchase whenever you make a purchase book or a sales book, the sales or the purchases must be in the form of credit. It should not be in the form of cash, because if it's in the form of cash, then that is something which is already recorded in the cash books, right? So let me see if there's something which I have missed revising. Just a second. Yeah. So one more thing. Quickly, if you want to revise the accounting equation, it is nothing but asset is equal to equity plus liabilities. So yes, that's it. We're done with this chapter. Make sure that you revise it properly and check out the part 1 of this video and the other videos as well. I've linked everything in the description box below. Thank you.